That is, the coronavirus exposed the existing problems, and now the market needs a catalyst. The Federal Reserve published a financial report on the current state of affairs. And since we're playing the coronavirus card, it makes sense to go all the way and pierce all the bubbles. Glad to welcome you to the Coin Post channel. More and more countries are easing quarantine, and investors continue to bring money to the stock market in anticipation of early economic recovery. Does this mean that the worst is behind us? Besides, the leading investment bank Goldman Sachs announced the end of the crisis 2 weeks ago. Let's try to figure out why they did this, despite the ample evidence that the global economy is steadily moving toward recession. Remember the rule: don't listen to what people say, watch what they do. So let's watch Goldman Sachs, the Federal Reserve, and more. Join our community. Support us by subscribing to the channel. Let's begin. Do you know the story of Lehman Brothers, the former largest US investment bank? I know I promised you Goldman Sachs, but that's the whole point. The history of Lehman Brothers started in 1850, and it had successfully existed until our century. And in the early 2000s, it was one of the 3 largest banks in the United States. But something went wrong, and the bank issued loans worth $680 billion, even though its assets were 30 times smaller and were as low as $22.5 billion. Obviously, Lehman Brothers found themselves at an impasse, and on September 15th were forced to declare bankruptcy. After what, the US stock market crashed by 33%. The Lehman Brothers collapse is considered the main cause and starting point of the 2008 financial crisis. But is that true? The S&P 500 chart shows that before the Lehman Brothers bankruptcy, the stock market had been unstable for 427 days, and during that time lost almost 20%. So Lehman Brothers acted as the so-called catalyst that pushed the market over the edge. What if today the situation is developing similarly? It's generally accepted that the cause of the current crisis is the global economy is in a deep freeze as a part of the fight against the pandemic. But what if it's only the initial stage? That is, the coronavirus exposed the existing problems. And now the market needs a catalyst, its own 2020 Lehman Brothers, which by the way could become Goldman Sachs. Another leading global investment bank, founded in 1869, is now predicting the end of the crisis and market recovery in 2020. And although the projectile shouldn't hit the same crater twice, and with the current speed of printing, the Fed could pour an extra $1 trillion in Goldman Sachs if necessary. Nevertheless, Berkshire Hathaway sold 84% of its shares in Goldman Sachs. Warren Buffett has already got a $49 billion loss and had the airline sale. He lost faith in Goldman Sachs and got rid of the stocks that he took at an excellent price in 2008. And as we know, Buffett's investment strategy doesn't imply the ownership of companies whose business is at risk. The most exciting part is, Buffett always insists that you should not bet against America, because nothing can stop it. But now the situation is that we stopped the train of the economy, took it off the rails, and sent it to a dead end. So the markets can be unpredictable. Would you agree that the position is somewhat ambiguous? It reminds of one of the Federal Reserve System. At the beginning of the video, I mentioned the watch what they do rule. Well, on Friday, May the 15th, the Federal Reserve published a financial report on the current state of affairs. And those who took the time and dug through these 78 pages could have gotten a little depressed. After all, there are such beautiful things as the possible drop in the price of real estate, mostly commercial, and farmland because they were too jacked up even before the start of the coronavirus story. But the most alarming thing is the emphasis on market volatility and the potential vulnerability to sharp price drops. Possible reasons are another pandemic strike, a significant economic downturn, or financial system problems. This was the report, that is, the document. And here's what the Fed chairman Jerome Powell said in an interview on Sunday, May the 17th. There's really no limit to what the Fed can do with its lending programs, and no one should bet against the United States. Well, point taken. The one who won't buy will lose, the investors brought their money to the market again, and the key indices got back to drawing green candles.
Shut up and take my money!
For some reason, no one heard or didn't want to listen to the words of Jerome Powell, who said that in the second quarter, the country's GDP is gonna fall by 30%, and that it's not worth waiting for a quick V-shaped recovery. The vaccine won't be ready for a long time, because if it's successfully developed, it'll take a long time to produce tens of millions of doses. And markets continue to ignore the fact that in April, US retail sales fell by 16%. It's the main engine of the country's economy, and the fact that there are no sales indicates a failure of the helicopter money idea. It was handed out to people, and now the authorities are deciding whether to inject another $3 trillion new dollars into the economy, some of which will be used for repayments to the population. But people are no fools. They understand that those who had savings before the crisis feel good now. Therefore, they are in no hurry to spend the money they got from the authorities and prefer to limit themselves to the basics and save the rest. What I also love is how they present the news about unemployment in America in a good way. For example, last week, only 3 million US citizens lost their jobs. It's not as bad as the 6 million per week in March. And for the next reporting period, they expect only 2 million applications for unemployment benefits. The fact that this indicator is falling is really good news. But why no one says that the number of unemployed is about to reach 40 million people? And after all, these people are still without a job, and it never happened during the last two crises. Meanwhile, the Fed's assets have reached $7 trillion. And as you can see on this chart, during the 2008 crisis, the Fed started saving markets after they collapsed. That is, the worst thing happened. Now, the Fed is proactive, redeeming everything they can through unlimited quantitative easing. As a result, government debt revved up and reached the $25 trillion mark. I'm not saying the markets are gonna collapse in 2 weeks, or the dollar is doomed. Those who make such statements, for the most part, speculate on other people's attention, and don't imagine, or don't want to imagine, the real consequences of what's gonna happen if, let's say, the United States default. Anyone who's waiting for something like that is not gonna have time to open a bottle of champagne they prepared, as their neighbor will go out the window, and they get a text about their dismissal. But we really need to do something about the current world economy financial indicators. And since we're playing the coronavirus card, it makes sense to go all the way and pierce all the bubbles. It's unlikely to happen now. While people are isolated, the public outcry would be too big. But after the situation is supposedly stable, the new Lehman Brothers may appear, as they won't cope with the pandemic's consequences and create a ripple effect. Share your thoughts about this video in the comments, please. And that's all for today. Thank you for watching. It's the Coin Post channel. Subscribe and get enlightened.